Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Hump Day. It's Wednesday, May 9th. Sorry for the delay on this. This is coming out a little bit late, getting close to midday trading here, but better late than never, right? Let's jump into it. We'll start off with some inflation data here, and this is the Producer Price Index. This is inflation on the wholesale side of things, so it kind of gives us an inside gauge of where potential inflation could go. It's not all important, primarily because we look at the CPI and the PCE reports, which are inflation on the consumer side of things. Now, sometimes when prices go up on the wholesale side of things, it doesn't always get passed on to the consumer, and that's why it doesn't always translate. It doesn't move the markets as much as, of course, the CPI and PCE here. So, with that in mind, we had a 0.3% increase back in month over month from into March. Forecast for April is supposed to be 0.2%, and it came in at 0.1%. Now, year over year, we had a pretty significant drop. So even though this went up month over month, we had a pretty year over year, because remember, these are on a rolling 12-month uh, calendar here. And basically, it dropped from 3% down to 2.6%, which is pretty great right there when you think about that. Now, when you strip out the food and energy, we get the core PPI on this, which creates less volatility here. This went from 0.3% in March. Forecast was supposed to be 0.2%, and it went up 0.2% in April. So when you strip out the food and energy, year over year, it dropped from like I believe it was 2.6 to 2.3% it was. So it also had a pretty significant drop here. So this is good to see here. Now, keep in mind, tomorrow we'll get the CPI report, and it'll give us a better gauge as to the inflation news on the consumer side of things, because that's obviously what we're really looking at and what the Fed is looking at. Their favorite gauge of inflation, of course, is the PCE, or the personal consumption expenditure, but CPI does have an important role in the matter as well. We got the wholesale inventories for the month of March. It went up 0.5% back in February, and the forecast is supposed to go up 0.5% in March, and it went up 0.3% in March. So still decent numbers here. So headline news: the stock market's up. Yesterday was kind of fun. We had of course, Trump's announcement, which the markets were kind of waiting for, on the decision to keep with the Iranian nuclear pact in place, and he elected to pull us out and add more restrictive sanctions on Iran. So what that does is basically, Iran is a big oil exporter, and this is going to tighten up what's the thought is it's going to tighten up on the global level of oil. So therefore, oil prices, as you can see here, oil prices got up and they exceeded the $70 threshold for price per barrel. Now, before, when we had some sanctions going on, my thought is we had some sanctions going on with it. The other oil-producing countries came in and increased their activity level, and a lot of them were trying to take market share. So Iran was trying to fight when they came back when the sanctions were lifted. They were trying to fight to get their sanctions, trying to get market share back, because they lost a lot of it to like Russia, Saudi Arabia, countries like those coming in there, and they had to try to fight that. So they had to try to create these. I wonder if my thought is, I'm wondering if this could play another role. And also, we've had some issues, or not issues, but instances where the U.S. also raising their productivity level as well, in terms of producing more oil to keep prices low. We're also coming into the summer season, which historically that is higher gas prices, because there's more demand on that as well. So usually, typically, oil will rise for the summer during what we call driving season here. So let's kind of jump ahead here to see how this is affecting the bond market and interest rates. And bond market is done, as you see, is coming down a lot further. We're starting to approach the next floor of support. We've been in this kind of middle range here, and now we're kind of moving downwards. We're currently down about 17 basis points, which translates to worse pricing for the day. As you can see, we got this 25-day moving average, and also 50-day moving average coming down even further. So this is going to further push us down lower if we can't break above it, which good chances of us breaking above it, at least on a long-term level, probably not going to happen anytime soon here. But rates have worsened today, so interest rates did rise a little bit today. Here's the yields. Yields are at a level here we got to be careful of. We're at the 3% threshold. We're kind of in this between range. It went up. It's at the 3% threshold. And if it breaks above this 3.04, it could dramatically change rates as much as maybe 0.75%, to the upside. So rates could go up another 0.75%. So again, we got to kind of watch this to see how this plays out, and hope that this ceiling will hold. At some point, yes, rates will go up, but in the midterm, we like to see them keep at least more of a moderate level where we're at currently than versus another big 3/4 spike in the rate. So again, let's keep fingers crossed here. All right, so that pretty much wraps things up. Come over to Twitter if you guys want to get more data. We did a release earlier today on the CoreLogics for delinquency rates and as well as MBA's mortgage application. I put on Twitter some of that information I do on a weekly basis. So just come over to Twitter, find me at Mike Bjork. You'll get more information over there. Otherwise, you guys enjoy the rest of your day. Thanks so much for watching. We'll look forward to see you guys tomorrow. Bye-bye.